Treasury yields continuing to spike on the heels of that Trump victory, with the 10-year continuing to near that critical 4.5% level. You're looking at the yield curve across your screen here. Investors betting that a Trump presidency could fuel economic growth, but could also risk reigniting inflation. That's showing up in these moves today. So here with more, we've got Sonal Desai, Franklin Templeton's fixed income chief investment officer. Sonal, it's great to have you here. So it's interesting. We still don't have the official results in terms of the House, but JP Morgan's saying that a red sweep could lead to a 4.6% level in the 10-year. And we see it continuing to inch towards that this morning. What do you make of that move?
So actually, I'd say that the speed of the move is probably to some extent a reaction to the results. We might see the move, we might see some volatility in the period ahead, and I would fully agree that that sharp spike probably to some extent is a reaction to the expectation of solid growth, deregulation, tax cuts, that type of stuff. And the other part of that, of course, is that it can lead to greater inflation and wider fiscal deficits. I actually have been calling for, without even getting to the stage of a sweep or not a sweep, we have been calling for some time for a Fed neutral rate of about 4%. And then if you assume that the economy is not going into a recession and an upward sloping yield curve, you actually already very easily get to the 4.5% to 5% level. So this move is sharp, and we might get some additional volatility as the market passes through the exact timing of different policies which might be enacted or might not be enacted. But I do think the directionality of it is exactly correct, and it could even be higher.
So now, do you think it's enough to make the Fed think twice before potentially cutting tomorrow?
No, I think that the Fed will cut tomorrow. The Fed, this is a dovish Fed, which does not like to surprise markets. Markets are pricing in 95% probability of a cut tomorrow. And honestly, there's nothing concrete in the data which would indicate that the Fed should dramatically change where it is positioned between yesterday and today and tomorrow. So they will cut by 25 basis points. However, the market, I didn't think that the Fed had made a catastrophic error or anything when they cut by 50 basis points. I did think they were somewhat imprudent to go by 50 when they could have easily done 25. And the economy didn't really need 50. Okay, so they've gone 50, they've done another 25. And I think they will do another 25, I think, tomorrow. After that, however, the market has gone a long way towards readjusting its expectations for Fed rate cuts to now bring the endpoint of the cutting cycle closer to that 4% level. Today, we're looking at really something like 3.75. So the market is actively pricing out rate cuts. I think that the Fed should take advantage of this and actually not encourage the market to expect massive rate cuts. Again, with the idea of prudence, because definitely we don't know how expansionary the fiscal position will be. I would note that under either presidential candidate, the fiscal policy was nothing short of profligate, whether it was 3.5 trillion or 7.5 trillion. 3.5 trillion only looks small when compared to 7.5 trillion. So I just note that, fiscal profligacy seems to be very, very fashionable.
Right, but Sonal, I guess the question is here, given the results that we have gotten from the election, the fact that we could be looking at up to 7.5 trillion of extra spending here over the next 10 years under Trump, and compared to what it would have been, clearly fiscal, I guess, cutting is not in the cards or not a priority really for either candidate. But here we have President-elect Trump, who has clearly put forward policies that may be inflationary. I guess at the Fed, how do you think the Fed is then assessing that risk, given what you were just saying, just the fact that there is so much uncertainty just in terms of what exactly the policy is going to look like?
So I think that that's why it would make sense for the Fed's endpoint of its cutting cycle, based on the last SEPs, was between 275 and 3. And now the market is almost gifting the Fed the possibility of changing what that endpoint would be. And I think the Fed should take advantage of that, and in its next set of SEPs, actually revise where it sees the endpoint and basically guide the market towards what the market has already priced. Does that mean that the Fed cannot cut at all? They can cut, but they need to cut more slowly, because if you get an immediate massive expansion of the fiscal deficit, again, we're looking at 7.5 trillion, which is over a period of time, but with big assumptions, because last time things which would on the margin be inflationary, like tariffs, those came at the end of 1 year. So, and again, we don't know to what extent the tariffs will actually be put on exactly as they were campaigned on, and to what extent these were initial positions for bargaining or making deals. We really don't know. So I think what makes sense is for the Fed to just slow down and wait and see before taking more steps. Yes, and it does have an impact. The Fed has less room to cut. I already thought the market was overpricing cuts, and now the market is moving towards what I think may be a bit more realistic.
Sonal, Desai, always great to get your insight. Thanks so much for hopping on and joining us here
Thank
this
you.
morning.